Okay, problem 87A is something you'll never deal with in Philadelphia. It's fairly common up here in coal country in Schuylkill County, where a company buys land for the minerals underneath the ground. In this case, it's a mineral deposit. Up here it's coal. It's the same concept. This company buys the land for $4,715,000. Now in reality, when they buy the land, they also have to put a certain amount of money aside to restore the land in an escrow account. That would be included in this. So that's the cost of the land. The 410 is the cost of the machinery. Now they tell us the machinery and the value of the land are both being depreciated according to their use. And that's common with the land. With the machinery, that would only be useful if the machinery is abandoned at the end, and that's what's happening here. If the machinery is sold some other way, you would depreciate it any other way. But first we have to figure out the cost of the depreciation per ton. So let's take a look at this. And we bought the land for $4,715,000, and that would include anything we had to set up, any restoration fund or any reclamation fees, things like that. And for that, we expect to get 5,125,000 tons of ore or deposit, whatever kind of mineral it is. So when you do that math, it works out to 92 cents a ton. So for every ton we take out, we reduce the value of the mineral deposit by 92 cents. Likewise, the machinery we paid $410,000 for. It too will be used to mine $5,125,000 worth of ore, or 5,125,000 tons of ore. So when we divide that, we find that we depreciate the machinery at the rate of 8 cents per ton. So there are depreciation rates, there are depletion rates. This is truly depreciation because it's machinery. This is depletion because it's a mineral deposit. That's the tough part of this problem. The rest of the problem is pretty straightforward. So they tell us in part C, part A and B we did already. Part C, they want us to do the machinery, and they tell us that the company removes and sells 480,000 tons of the ore during its first 5 months of operation. So that's as of December 31st at the end of the first year. Remember, they bought this July 23rd. That's the end of July. So there's only 5 months left. August, September, October, November, December. That's all. There's 5 months left. Now, had they bought it July 1st, it would be 6 months. Okay, so we have depletion for the mineral deposit. They tell us 480,000 tons, 480,000 tons times 92 cents a ton. That's 441,600. So that's our depletion expense. So our depletion expense, $441,600. Now this text tells you to go to accumulated depletion for the mineral deposit. Many books and many companies that I know actually just go directly to the asset, so they would be crediting the value of the mineral deposit, not crediting accumulated depletion. Either one is the same. You're putting in the same amount of money, $441,600. That's recognizing the mining of that 480,000 tons of whatever this mineral is. Then we have to look at the machinery, and this is depreciation. It's 8 cents per ton. So for every ton of this deposit we mined, we used up 8 cents worth of the machinery. So the depreciation expense for the machinery is 8 cents per ton times the 450,000 tons. I believe that's what it was, right? 480,000 tons. So we have, this is 92 cents times the 480,000 tons extracted. This is 8 cents a ton times the same 480,000 tons. And when you do the math, this comes out to be 38,400 depreciation expense. Accumulated depreciation machinery, 38,400. The only thing to keep in mind to remember about depletion, it works exactly like depreciation. It's almost always done on a straight line units of production basis. It really doesn't make sense to do it any other way. And you have two options. You can either directly reduce the value of the asset, or you can keep track of the accumulated depletion. Both are acceptable, both are common.